Good afternoon and welcome to Stonehearth Capital Management's quarterly update webinar series, CIO's Corner, with our Chief Investment Officer, Chris Gauthier. My name is Amanda Sylvia, and I'm the Senior Client Service Associate for SCM, and I'm so happy to be assisting Chris today. I do want to start off with a few housekeeping items. Please use the Q&A button on your Zoom taskbar to submit any questions that you might have throughout the course of the webinar. I will be monitoring those questions throughout the course of the webinar, and we'll ask Chris to answer as many of those as he can get to at the end of the webinar. If we do not get to your question, Chris or myself will reach out to you to make sure that we do get your question answered. I am so excited to introduce our speaker. Chris Gauthier is Stonehearth's Chief Investment Officer. Chris brings more than 20 years of investment management experience to our firm, working with both institutional and individual investors. He is responsible for setting our firm's overall investment policy and strategy, including directing our asset allocation, investment risk, research, and portfolio management functions. Chris, thank you so much for speaking with us today.
Thank you. Thank you, Amanda, for that wonderful introduction. And thank you all for joining us today on sunny Massachusetts afternoon here. Nice to see the sun out as we get the last vestige days of summer in here before fall begins to change the leaves. So we do have a lot to cover, as we usually do. So let's kind of jump right in, see what we're going to go over this quarter. As always, we look at the asset class performance, kind of what happened. And as we'll show you, we really saw a broadening of the equity rally, which was good. Definitely had a risk-on feel as on reduced recession fears by investors. Not all markets agreed with this, but in general, you see that most asset classes had a very strong quarter, which led to a very strong trailing 12 months return. Now we'll look at the investment environment. And, best we can say it's mixed, right? We have a hawkish Fed, no surprises there. We see some slowing economic data, which we'll go through. We're at elevated valuation levels in certain asset classes, with some excessive sentiment being built up. Really being offset by very strong technical backdrop, right parts of the market are performing well. We're seeing moving averages up and to the right, resilient consumer, which we'll talk about, and an expected AI boom. And then lastly, we'll kind of take a look at how all this data kind of gets put into a model, and we use a weight of the evidence to impact portfolio positioning for our clients. So with that, let's look at Q2 2023. Very good month for most financial markets. You can see skewed to the left, really led by the US, which is always in blue here in all these bars. It was a risk on. Investors put aside Fed economic concerns, really leading to gains across the equity complex. In addition to the US in blue, you can see green international did very well too. US led by NASDAQ, up almost a little over 15% in the quarter. That was really driven by the Magnificent Seven, those names you keep hearing about over and over again, all over the complex. Top 10, whatever you want to call it, we've kind of congealed around the Magnificent Seven, but the names Apple, Microsoft, Google, Amazon, NVIDIA, Tesla, Meta. They kind of make up the majority of those market cap weighted indices, and they really led performance in the quarter. As you saw, safety was out of favor. So when we think about safety, we think about those safe haven assets. What are they? Long-term treasuries. You can see them right here, and gold, both down over 2% in the quarter. And most fixed income, which is in purple here, had negative quarter. We did see some good pickup in performance in fixed income in credit, which is by high yield and floating rate. So that helps, but overall it's definitely risk off in the fixed income markets. The one asset class really bucked this trend is oil. You can see it down 4% because you would expect, given all with the thrust we're seeing in the equity market and the rise, that oil would do very well in that type of environment. It just didn't. It traded a little bit differently. Economic concerns, top sentiment, and the different market participants, right? Different people trade in the oil market, and they have a different view on what they're seeing in the economic data and the equity market is. So looking at a longer term performance, a 1-year performance, it's almost the same chart we just looked at, right? A few things here and there, but the skew is very much the same leaders. That NASDAQ's leading the way with the Magnificent Seven having the best performance, followed closely by the S&P 500. We have international jumping a little bit ahead of the other US asset classes, but still very strong positive returns. We do see stronger returns in the fixed income market, but only in those credits, right? Those more risky parts of the fixed income market and high yield, floating rate, giving you some decent, almost 8% returns. And the safe haven asset, long-term treasury, still not keeping up with the marketplace. They're down almost 8%. The one bucket of the trend that we've seen from the last chart is gold, right? We saw gold down, really sell off in the quarter. Over the past year, still up almost 6%. Very strong return from gold over longer terms. Even the short-term weakness is not denting that performance yet. And really, this is just due to the just robust returns we've seen in 2023, plus some rolling off of some pretty bad months, 2022. Really glad that year's in the rearview mirror and don't want to, participate in that market again. So that's kind of where we've been. Right now, we want to take a look at the current market environment, kind of see what it tells you about what's going on in the marketplace, how much risk to take, and what and which way financial markets may move as 2023 goes on here. The biggest and most important factor we see right now is just the Fed, right? We've talked about this chart over multiple webinars now. We're always going to begin with this chart until we don't have to. It's just the biggest thing in the market right now is what's the Fed going to do. It's the most important game in town, the Fed and monetary conditions. And I love this chart because it kind of sums up everything we're looking at. Since we last spoke in April, the Fed's had 3 meetings, raised interest rates twice. They did pause in June. So now we have an interest rate level of a range of 5.25 to 550. Remember, the Fed doesn't give a point estimate now, they give a range. I know here, we're looking here, it's 513, but this is as of June. It does take into account July raise. But again, it still tells us the same picture. What is the Fed going to do? They tell you, right? They're very nice. They have their meetings, year-end estimates, and they give them to you. And then with the market, we can see in the futures market, what is the market expectations for what the Fed's going to do? And we can see that there's a gap there, right? So the Fed's telling you what they're going to do, the market doesn't believe it. And the good thing in the quarter was we saw that gap narrow between those investor expectations in the green line and the Fed in the blue line as the investors move closer to the Fed, right? The Fed kept saying we're going to do this, investors didn't believe them, but in the quarter they finally threw in the towel and said, you're right, you are going to be a little bit more hawkish, and they moved closer. They didn't move all the way to them, right? So they're still a little bit more dovish, but they pushed that out to 2024. When we kind of look at this at Stonehearth, we really don't want to fight the Fed, but we understand there's multiple levers and factors to pull. But we still feel investors are a little too dovish, as the data points to a more hawkish Fed, and that we will be higher for longer in interest rates than the market expects. And so we're going to take a look at this data right now. And the first data point is not part of the dual mandate, but it's the current monetary conditions. And what we look at this is we look at the nominal 10-year treasury yield, taking out inflation, which gives you this real yield in the brown line right here. And we see that it's negative. To us, that's the cost of money, right? What does it cost to invest? And when you've seen throughout history that, yes, it can be negative. It was negative in the 70s. Don't want to remember those times. It was not good times, but it has been negative. That really means monetary conditions are easy, right? The cost of money is negative. We look throughout history that even though we've been there, we're not there that often, right? Because there should be a cost of money. There should be a cost to money. And we see that throughout history that it tends to be positive. So when we look at the Fed and we hear all the press say that the Fed is tight, they're so tight, they're so restrictive. We're not seeing that in the data yet. We still have some ways to go before we get to normal restrictions. That being said, we're definitely tighter than we were going in. So we definitely made this jump. We were at almost 5%. Now we're only at 1.52. So we're definitely tighter, but we're definitely not restrictive. In addition to that, another supporting of the Fed being higher for longer is the Fed's own dual mandate, right? We all know they have a dual mandate. First mandate is price stability, and define that by inflation at 2%. Where they come up with the 2%, someone just said it at a press conference back in the 50s. They kind of stuck with it, which is kind of funny to me. But for lack of a better word, that's what they define price stability at. And also full employment, which economists tend to see is right around 3%, because any lower and you get this friction and people moving jobs, you never get to zero. But both are really supporting higher for longer. And we'll take a look at inflation first. What we're looking at here is the CPI, which is Consumer Price Index, a very broad measure of inflation. That's the blue line. You see it next to the brown line, which is the core. So the core is just the headline, X food and energy, because the Fed thinks food and energy, no one needs to buy them, and they're too volatile to put in their inflation numbers. I digress. They do look at the core more than the headlines. They want to take out that volatility, but both are saying the same thing. Inflation improvement for sure, but really a long way to go to the Fed's 2% target. We look at the data here. The core is at 5.3%. And the most recent reading came in at 4.86. So definitely improvement, definitely headed in the right direction, but still got a long way to go. They're still 50% above that 2%, right? They're only at 5. So there's low-hanging fruit, going from 9 to 6, 7 to 5 to 4 is kind of the easy stuff. They pick that. And it's really the hard part is getting it for that last bit, right? Just pushing it over the line from 5 down to 2. It's still a 50% drop. So a long way to go, which is providing support for higher rates for longer. The other data point providing support is the employment market, right? We're seeing very robust job market. I'm sure we've all heard about it. We look at the job market, we're looking at the unemployment rate, and right now it's at 3.7. And like we said, full employment's at 3. So the Fed has room to raise rates as long as this doesn't break, right? What they're looking for and what they're afraid of is if they see a spike up to here, right? They don't want to see 6% employment rate, 700% employment rate. As long as they're down here, they're very happy to keep raising rates. And that's going to be the tendency. That's going to be their bias because they really have to get inflation in line. So a healthy labor market is providing support for rates higher for longer. The other aspect of the labor market that's providing support is this wage growth, right? And we talked about core inflation being a little bit under 5, and we're seeing wage growth at 5. So what we're seeing for the first time in a while is actually real wage growth, right? Because you have to pay for certain goods, and when that inflation goes up, you have to pay more, but your wage grows and offsets that. You actually get more money in your pocket. Consumers have more money to spend, which is good for consumers, and we always want to see people get jobs and get more money. Not so good for the Fed and their mandate to get inflation down. Because you think about it like your own life. If you get more money in your pocket, some of us should save it, but most of us will go out and say, okay, I have more money. Let's go buy something. Let's go spend that money. So that money goes out and increases demand. And when we increase demand, economic theory says prices go up. When prices go up, what does it impact? Inflation. So the strong job market not only is providing support being low unemployment rates, providing more money that is pushing inflation higher. So again, both indicators are supportive of higher rates. And when we look at the labor market, we do see some weakness. We do see it coming off the boil, but not crashing in the least. We're looking on the left-hand side, job openings. So how many jobs are open? Definitely coming off a boil, but still very elevated compared to history. So if there's one job, it should be one open out there for you. To me, quits is one of the most important ones to look at because you don't quit your job unless you have another one or you have a very high confidence level that you can get another one. And if you have that, it's a very robust job market. So again, like all the data we're seeing coming off the highs, but still very elevated and points to a very strong future job market. And layoffs too. We hear all about this in the headlines. In fact, CBS just laid off another 5,000. And while one layoff is one too many in the financial markets, they're still not elevated. If you look at the data here, that despite what we hear in the press, even though those tech layoffs in the CBS is still at pretty low levels for layoffs. So all the data is really pointing to a very strong, robust employment market, which all leads us to believe that the Fed is going to be higher for longer than the market expects. I mean, this rosy employment picture is also providing support for the consumer, which is proving really more resilient than many expected in 2023. It's 7% of the economy is consumer, and we can see on the next chart, they're doing pretty well. We look at the mortgage rate up top, and I just included a few data points. And we see this big rise up. Never like to pay 6% when we used to be able to pay 3%. But when we go look at the mortgage rate throughout history, it has been at this level. So what I'm trying to show here is that, yes, there is a big jump in mortgage rates. Recency bias has compared that to the 3% range, but we go throughout history, we've had rates this high before and still had a very robust housing market. So high rates don't naturally crater a housing market. And then we see that in the prices. If we look at the next chart below, the Case-Shiller price index, and we can see that, yes, it's not growing like it used to from 2020 lows, but it's not cratering either. And in fact, if you look very closely, you can actually see maybe a little uptick there. So even with these higher rates, you still see a housing market that is not falling out of bed, which is providing support for the consumer. Then we look at that, and we can see that translate in consumer sentiment numbers. And sentiment is just how the consumers feel about the future, right? Are they confident in their future? And they haven't been as confident as they have in the past. It's at 64. This has been at 70, but it's coming off readings of 50. So we're moving in the right direction. And then to me, the most important chart for the strength of the consumer is the bottom one. It's debt service. And basically what this chart is just looking at how much as a percent of disposable income, so how much you take home after taxes, not your gross. This is your net. This is your take-home pay. Are consumers paying of that to pay down debt, even if they're only paying interest? And we look throughout history, that has averaged about 11%. Sometimes it gets higher. When that tends to get higher throughout history, you can see bad things happen in the economy. And it makes sense, right? For better or worse, I think worse, but we all have an opinion, this economy runs on debt. Consumers use debt to spend and buy everyday purchases. And they will continue to spend and buy everyday purchases as long as they can afford the debt. And as long as those payments stay in a reasonable level, then they can have a propensity to spend and have the capacity to spend as well. And we see right now, look at the data, it's still well below average at 9.63%. So this gap, until we see it up here, they still have more room to spend, which is providing support for the economy. So the strength we're seeing in the consumer is really being offset by industrial weakness. And we started with saying we're seeing mixed data, and we're really seeing it from the industrial side of the economy. There's this disconnect between the two camps. And this can be seen very clearly on the next chart when we look at the forward-looking PMI data. And what these are surveys. We've shown this every webinar. We talk about it all the time. They're diffusion indices, right? And they're questions that are asked corporations and saying, are things getting better, staying the same, or getting worse? Add all those up, and it gives a good indicator of where the economy is going. And history shows that anytime these indices have been above 50, it shows an economy expanding. Anything below 50, you have economic contraction. And you can see the clear dichotomy between the two. Services, which is a proxy for consumers, you can see is very robust, heading upward to the right, showing full-on expansion in the economy. While we look closer to manufacturing, which ties more with the corporate and the industrial, you can see it heading to new lows here in this cycle, down to 46. So again, that's where we're kind of seeing these mixed signals there. One thing that's not showing a mixed signal is inverted yield curve. It is screaming recession, top of its lungs. But at least for now, not a lot of people are listening, which may be to their detriment, because we've seen throughout history that the inverted yield curve here is a good sign of a recession. And there's no mystery to this. The inverted yield curve it just takes a long-term rate, say the 10-year rate, and then minuses a shorter-term rate, say the 2-year rate, and that's that red line. When the 10-year rate is lower than the 2-year, you get a negative reading. Now, that is not the natural state of the economy, and it makes sense. The longer you lend money, the more higher the interest rate should be, because there's more risk the longer you lend money, and there's also the risk of inflation. So the way I kind of view this is I have 3 children, and they get sick all the time, and I'm sure people have children on this call, and when you get a child sick, the first thing you do is, do you have a fever, right? That's going to give you a signal something's really wrong. That's what this inverted yield curve is. It's a fever, right? It's just a sign that something is amiss. Something's not right in the economy. And history shows that what's usually not right is that we're headed toward a recession, and we need to do some adjustments. And that usually ends up being bad news for the financial markets. So that's kind of why we look at these things. And right now it's screaming recessions. So looking at mixed data in the economy, we're now going to turn to the financial markets, equity and fixed income, and we'll start with equities, and we're going to view them through, technical sentiment valuation lens, really to glean insight into the strength or weakness, of the market and what it may say about future returns. And the first thing I want to show, and we talked about, is the increasing breadth we're seeing in the market. This chart is from our friends at Ned Davis. It's a great model, and basically it's looking at ACWI. Now, don't get scared about those words. ACWI is just another equity index, just like the S&P 500. The only thing different is it includes global stocks. So not just the US stocks, it also includes stocks from France, from England, from Japan, from Brazil, and the EM. So it includes the global equity market. And we look at what they're showing here, we see the percent of stocks above the 50-day moving average, above the 200-day moving average. And what it's just showing is that there's a lot of stocks participating in this rally. Anytime you see a reading above 50, we can say markets are broad. And why we care about this is because, rallies are strongest when broad. The more stocks participate, the stronger and more powerful they are, and weakest when narrow. And at least after what we've seen in June, we've seen some nice increasing breadth. So this is lending to the positive technical picture. A lot of stocks are participating in this rally now. What's not so positive is sentiment. And we're looking at sentiment, we're just looking at how investors feel. We have a whole bunch of indicators. Again, we're using the data we use from Ned Davis research. It was founded by Ned Davis, again, so he named it after himself, but it's a company down in Florida. They've been around since the 80s. They have multiple analysts putting together all this data, and we use them to kind of put together some of the stuff that we have. And they do great work. And, we're seeing extreme reading on sentiment. You can see it up here, and they kind of define it like a little above 65 is extreme, and we're just above that. So it's definitely bearish. Kind of the way to look at this is, the crowd is not always wrong, but at extreme levels, they tend to be more wrong than right throughout history, and that's what this is capturing. Kind of the simple way to look at it is, if everyone is bullish, who is there left to buy, right? There's no incremental buyer out there. So this is kind of offsetting that breadth we're seeing in the marketplace. And when we see this increase in sentiment, it really did help push the index higher. And now we're going to turn to the US and look at just the S&P. And we see this rise in the past quarter from the performance. And what we're looking at here is the valuation metric. And what we're using is PE. And this is just price over earnings, or how much you're paying for $1 earnings. When it gets elevated, you're paying more for those earnings. When it gets lower, you're paying less. So in other words, what this chart is telling us, when we look at this line, which is the PE ratio, is at the end of Q2, which is right here at 19.13, investors are willing to pay more for the same cash flows. And remember, when you invest in equities, you're investing in their business and investing in cash flows than they did at the end of Q1. Not at extreme levels, right? We're not above that one standard deviation event. We're not seeing what we saw in there COVID. We're not seeing what we saw back in the dot-com bubble, but definitely heading that way. And this is not sustainable long-term, because when we look at it, we really need those fundamentals to come along. And right now, this performance we're seeing is just driven by multiple expansion and sentiment. So again, we've seen before, fear and greed can drive short-term returns, but fundamentals overrule them in the long term and exhibit more pressure for the long-term performance. So at least from an S&P 500 standpoint, we're seeing some overvaluation. Before we move away from the S&P, I really want to address concentration risk. We talk about it a lot. We mentioned it before, and those Magnificent Seven stocks, they're about 27% of the indice, and they've accounted for almost 77% of the return. And we talk about this a lot. We've shown a lot of charts, and it's a concern for us, right? Not so much that the top stocks are leading; they should, right? That's normal. They're the biggest companies in the economy in the US, and they should be doing well. It's just this magnitude of outperformance that is really driving our concerns. And we can see that very clearly on this next chart from Strategist. And what they're looking at here is going back in time, looking at all the times the S&P had a positive return, taking the top 10 stocks. Again, when we think about the top 10 stocks today, we're thinking about Apple, Microsoft, Google, Amazon, Nvidia, Tesla, Meta, Berkshire Hathaway, and just showing what percent of the return they are. And we can see that the return so far year to date is at extreme levels, right? Not so much that they're outperforming, it's the magnitude. We look throughout history, it's the second highest ever. And I don't want to tell you the first highest, but very close to it is 2007. I don't think too many people want to remember back to what happened after that. That's not saying that's going to happen here, but it's just saying that there's a very high chance, very increasing risk in the marketplace when the returns are concentrated in those few stocks, and it is not normal. It's normal for those stocks to lead. It's not normal for those stocks to lead by this much. And we do think there's a risk of that correcting itself very quickly. So with this concentration risk, right, there is positives. So every time we look at risk, we have to look at the other side of the risk coin, and that's opportunities. And some of this sentiment and some of this concentration in these names have provided some good opportunities out there. In some other asset classes that have not participated as much and have stronger valuation support. And we're looking at a chart here from State Street. We're looking to similar stocks we saw before. We're just kind of breaking them down to more buckets. So that top line, still the S&P 500, which we looked at before, but now we've added small cap stocks, even in the S&P 600, value growth, which is just a combination of the S&P, but slicing and dicing in that, adding EFRA, Europe, EM, and a whole bunch of countries. So overall, the same things we're looking at, just in more buckets. And there's a lot of data here to unpack, but I'll keep it simple for everybody. Green is good, red is bad. We see green, valuation support. We see red, very expensive. And like we saw on that PE chart, the S&P is very expensive. But there are pockets. We look at small cap, right? Haven't participated as much in the rally so far. In international, same story. We look some decent in performance, decent valuation support in Europe, EM, some of the European countries. So there are pockets of opportunity if you know where to look. And then we look at these international in particular, you can see that they're just starting off, like we saw in the concentration risk. It's not that they're underperforming, it's the magnitude of this underperformance and the magnitude of the valuation discrepancies that's providing the opportunity, right? The magnitude of the outperformance on the Magnificent Seven is a risk, but by doing that, they create an opportunity in these other asset classes, international being one. You can see it's almost down to 2 standard deviations. So again, not that they're cheaper than the US, they usually are, it's just this magnitude. And look on the right-hand side, you can see just the impact of yields we're getting by going to international. And I like to look at this chart too, because, we always use history as a guide, and we can see that there are cycles, right? It's tough to remember since you've been in a 14-year bull market for the US, but you go back in time, going back to the 70s, we see that there are many cycles of strong international outperformance. You look back in the 70s, 2.5 years, outperformed by 80%. At the end of the 70s, 89%. Big one in the end of the 80s, 300%. And then we see US, for 200% in the 90s. So you can see there's a long cycles that go through with big moves. And we look at what we have right now, international is just starting to come out of the shadow of this big, large US outperformance. So again, what's this telling us is that with the valuation support, and with the cycles throughout history, you still have a little bit of room to run here. So it should be providing some opportunities for investors to pick up some excess return. So that's for the equity market. Now we're going to turn to fixed income. We're not going to spend a lot of time here. We covered a lot of this with the Fed, right? Because they just have such an outsized impact and they can control the interest rate. And since they control the interest rate, and we know they raised it 2 hikes since we've met, and they continue to be hawkish, as they push, we see the rates go higher across the curve. And we see where we met last time. It's the aqua green, right? This is where we met. This is what the rate looked like then. This is what it looks like now. And again, there's no mystery to this yield curve. It's just looking at US Treasuries, right? So just Treasuries. And at 1 month, what is the interest rate? At 3 months, what's the interest rate? 1 year, what's the interest rate? So forth and so forth, and just plotting those dots in a line. And all that is saying is that 1 month, when we met in last quarter, it was yielding 4.5, but since the Fed raised rates 2 times, it's now 5.1 for a 1 month rate. And that's all it's saying. What we do see, there's other information we can glean from this, and it's more to do with the shape of this, right? As these hawkish Fed, it led to a flattening of the curve last quarter. And all that means is shorter rates rose greater than long-term. And we just saw a flattening of it, or it's shifting down to the right. Historically, this has not been a good omen for the economy, because like we saw in the inverted yield curve data, a flattening yield curve has historically been associated with slower growth. So that's what the bond market is saying, is that they see slower growth, kind of disagreeing with the US market. So only time will tell if this leads to a recession. But right now, combining all the weight of the evidence, while improving, the tilt is still, unfortunately, towards a recession sometime in the future. Timing is up to debate, but again, still leans towards that, even though with the improving economic data. I want to wrap up fixed income here with higher rates, right? So higher rates get a bad rap, right? And then you see everybody screaming, Jim Cramer being the best, never raise rates, don't raise rates, always have low rates. But they do have some benefits, right? Low rates do hurt people. And these benefits of the higher rates are savers, right? Because we now actually have some income in fixed income. Lo and behold, imagine that. A whole category built around yield actually has some yield now. And it hasn't for a long time. So what we're looking at here is multiple sectors of the bond market, US Treasuries, investment-grade corporates, mortgage-backed securities, and the like. And looking over the past 10 years, this is the range of the income that they produced on an annual basis. And this is the average of those 10 years. So you can see with the Fed keeping rates so low in the beginning, you can see just how little income was had. Inflation up at 2%, earning 1.5% on Treasuries is really not a good trade-off. A little bit different story when you get up to about 4.4. And even for those investors who can take a little bit more risk, we are seeing some good opportunities to pick up some nice income. We look at EM debt up at 8.4% and high yield up at 8.5. So again, even if we see Fed raise rates one more time and hold, you're still getting paid because you're sitting there clipping a coupon, right? The worst case scenario is not that bad, sitting here clipping an 8.5% coupon in high yield. Now, there are some risks because it is corporate debt, but you're being compensated for those risks with the high income producing yield that we're getting now. So there is some benefit to high rates, and it can provide some opportunity if you know where to look. So with that, we're going to start turning to our risk models. First one is, we're going to look at Ned Davis Fab 5 composite. I've shown this before out here, again, from the same company that we get a lot of our research from down in Florida. He uses 80 individual indicators, all rolled up into 4 composites right here. When we look at this, we want to see the change when we talked about it last quarter. And last quarter, this was at a 1. And we can see from his indicator right here, he's still at a 1. So no change. That kind of hides a lot of action underneath the surface. And we can see that actually in April, right, you see this big jump up to 4, his model actually ended into a buy signal. So that was triggered on April 14th, and that remains in place. And that while we're last quarter at a 1, we're not 1 now, that buy signal did change his outlook during the quarter. And we also saw some movement underneath the hood, right? So that tape, that's technical. And he counts that twice because he really believes in tape matters and follow the price. That's bullish, and that was neutral last time we met. So that's a positive influence. He's catching the same sentiment we saw before, that just investors are getting a little too frothy in their belief in the market keeps going up, and getting a little bit too extreme sentiment. That's being offset by monetary policy that'll be getting weaker too, as we saw it is tightening, right? It's not tight by any stretch of the means, but it is getting tight. So again, we're looking at him from last quarter, no change, but he is on a buy signal. In addition to his model, we also create our own internal model of 16 components, right, to complement, fill in the blanks from Ned Davis research. It's more tilted towards valuation and economic data, tends to be smoother, slow and moving. We built it around technicals, and technicals we look at reversion, and reversion is just, markets move up and down, trees don't grow to the sky. So we're looking for good long-term entry and exit levels. Structure, right? We want to see the right part of the markets outperforming. Markets are strongest when broad, weakest when narrow. So we want to try to capture that. We look at valuation, right? Because we know that most bull markets begin when markets are cheap. Look at economic, right? Because that economy will give you insight into where companies are going, and companies depend on the economy to provide growth and earnings. And then qualitative, right? Which is just anything that just can't be captured by a quantitative lens. And we use our judgment framed within a quantitative framework to come up with that indicator. So we're picking up some of the same signals as Ned Davis, slight decline in the headline number due to a slowing economy, and we'll point that out. But we've talked about that slowing economy, and we have more economic weight. But we look at our model, we look at the technical, top part, no change, the overall score, right? See, we're at 4, 2 + 2 is 4 last quarter, and now 3 + 1, 4 the last quarter. Change is really due to the upward move due to increasing breadth, was offset by sentiment, as we measure it, and we measure sentiment using the VIX, but it's trying to get at the same exact thing. The technical picture, all in all, weight of the evidence still leans positive at a +4. Valuation, we use CAPE, which is a longer version of the PE ratio, and much better version, takes into account 10 years of earnings data and takes into account inflation. We use dividend yields, that's a good starting point, and we also use earnings. So negative across the board, and actually got worse in the quarter. Earnings are in full swing for Q2, coming in slightly better than expected, down 7 compared to expectations of down 9. But that bar was so low, and we're not seeing forward estimates move incrementally that much higher. So we're not seeing any improvement in that indicator. So overall, the valuation picture is still not supportive of risk assets. Look at the economic data. We see all that decline by 2, and that's kind of headline model fell. Really due to copper prices. And we can see that copper was positive last quarter, and now it's negative. We use copper as a good indicator of future economic activity. In fact, it can say that it has a PhD in economics because it's the beginning of the production cycle. It's a raw material. And when we see increases in prices of raw material, it usually means that production is increasing, and they're calling on the demand and going out and buying it, which drives prices up. Vice versa, if they're seeing a weakness in demand, they're not buying as much copper, and you see the demand for copper come down and the price come down. So it's a good judge of where future economic activity was going, and it really fell below into negative category in Q2. So again, that does point to slower growth. So like we showed earlier, the economy is slowing, no doubt about that, but not in contraction, and still leans neutral for risk assets. Look at the qualitative piece. It's Fed, Fed, Fed. Don't fight the Fed. They say they're going to be hawkish. We take them at their word. Look at the data, leads them to be hawkish. So again, even though they're still on an easy monetary basis, it is getting tighter, and that tighter is acting as negative force on the risk markets in there. So that's what the risk models are telling us. So how do we create a portfolio? Well, we take all this real-time data and really use it to make asset allocation decisions based on actual vol and risk we're seeing in the marketplace. So that leads us to these over and underweights. This is to our Stonehearth Capital's moderate benchmark. So conservative clients, aggressive clients, custom portfolios may be a little bit different, but in general, it gives you a good idea of how we're positioning client portfolios. Look at the headline equities. We did continue to reduce our underweight to US equity. So we add to that a little bit on improving technical picture, improving tape. And that moved global equities, which includes international EM, to neutral. So we're still underweight US. We still saw that concentration risk. We did see some pockets in small cap that you can add to, but really, getting nervous about those elevated valuation levels and sentiment. So it leads us to an underweight US. On the flip side, creating opportunities in international EM markets with those better valuation pictures and the longer cycles that could play out on that side. In fixed income, we moved from overweight to neutral in the quarter, really to fund that improving tape we saw in the equity market. Still overweight credit compared to duration, but we reduced that gap a little bit. Still like the short end better than the long end right now. And again, you can find some attractive yields in some different generic products out there if you know where to look. Still overweight cash due to attractive yields. Like we said before, rates have a benefit of going up, and one of those benefits is you can get almost 5% in cash-like instruments, be it a flourish account that we offer here, or money market. So those rates seem attractive, and we like that having overweight because it provides liquidity should a market opportunity arrive. And speaking of those market opportunities, we're not seeing a lot out there right now, and we remain underweight opportunistic. Still like a few plays, gold for more conservative clients, and then for more aggressive clients, we have gold and clean energy and some gold miners, have a higher risk tolerance. They may be appropriate. And for those who are really on the high on the risk scale, we can even add some banks, given the recent sell-off we've seen in that complex. But overall, we still remain underweight opportunistic. So that's really how portfolios are positioned. Before I turn to questions, kind of want to sum up what we talked about here, what we're seeing in the economy, and what we're seeing in the marketplace. Stock market rally broad in Q2, saw some good breadth. There's more and more stocks participating, but we still have a concentration risk in those magnificent 7 stocks. Hawkish Fed is out there, and we think they're going to be higher for longer than the market expects. And what could change that outlook? Well, again, we talked about the dual mandate, right? Inflation. We saw how that, while improving, is nowhere near the levels that would get them to lower rates. We talked about employment, still a very robust employment picture, strong job market. So if they're not breaking anything in the job market, there's no reason for them to lower rates or even stop raising rates. And the one we didn't really talk about a little bit, but they've talked about before, is bond liquidity. And this is not companies making no money, not being able to borrow. This is the GEs of the world, the JP Morgans. If there's a kink in the bond transmission and really good companies are having trouble getting credit, then you could see them lower rates. And we don't see any of that in the marketplace. And that's really an extreme event. But as long as those 3 remain intact, higher for longer is kind of what we see. We saw a consumer proven more resilient, right? Based on strong employment. We saw some decent housing numbers, and debt levels, at least for now, appear manageable. So strength of consumer is a positive for the economy. That being said, the probability of recession, while decreasing based on the consumer, the way that the evidence still leans towards a recession, even if it may be pushed out a little bit. We're seeing improving technical indicators in the equity market, being offset by some elevated valuations. And like we talked about, the concentration levels, where you take risk matters, right? Small cap we saw has a bit more valuation support, and international has history and some valuation support on its side to maybe give some clients some excess returns. Turn the fixed income market, really saw that flattening of the yield curve, really based on just the hawkish Fed, really indicating the bond market, unlike the equity market, is expecting slower growth ahead. There is a benefit to the Fed raising rates. It's not all negative. Yields appear attractive compared to recent history. You're being compensated for interest rate risk, and you can hold fixed income just based on the income for a change. Look at the overall, we see the technical, we talked about this, we saw good breadth, we saw good moving averages, so the technical tape is very supportive for adding to risk. We talked about valuation still elevated at the headline industry level, not seeing earnings really come through, so that's still really not supportive for financial assets. Economic data, definitely mixed, strong consumer, looks like the weak PMIs, inverted yield curve. So really that ends up being, we use the weight of the evidence approach, neutral on risk. So summing that all up, what are we doing? Well, we're remaining patient, right? And really watching those charts and the data for stronger signals to emerge, which way the economy is going, which way the technicals are going, can it break through to new highs here? And until we see some of those indicators lean one way or the other, we're just going to remain patient. So with that, I want to thank you for joining me. I do know we did leave some time for questions, so I'm going to turn it back over to Amanda to see if there's any questions out there.
Hi, Chris. Thank you so much for all of that information. I do have a couple questions for you. We have a few questions involving the Fed, so I am going to just try and consolidate some of those questions. Basically, the questions revolve around what we think about the Fed's actions. Have they done enough already, and what do we think they should do?
Thank you for that question. Interesting. Yeah, to start, I do have opinions on what the Fed has done and what they should do. But we here at Stonehearth, we really don't spend a lot of time on that because it doesn't matter. It's not what's most important for client investment portfolios. What's really important is, and the question to kind of, if you allow me to really be asked, is what the Fed is going to do and what does the market expect the Fed to do? Because that's what's going to move asset classes, not whether I believe the Fed's right or wrong in what they're doing. It's really what they're going to do and what the market expects. So this is what is going to drive asset class performance. So the question is really, what's the Fed going to do? And as we saw in the data, given high inflation, improving for sure, but nowhere near the 2%, strong employment market, no problems in the bond market, and the Fed saying they're data dependent, that data is telling you that they're going higher, at least a little bit, probably one more rate this year, and they're going to hold there, or at least stay higher for longer than the market expects. So that's kind of where we stand on that. It really matters more what the Fed's doing, what the market expects, than what I think. Thank you for that question, though.
Thanks, Chris. We do have just one more question, it looks like. Does the current equity rally have legs, and where would you invest right now?
I wish I knew, right? I wish I had my crystal ball out there to see if this had legs. But we kind of have ways to view the market. We use a weight of the evidence approach. And like we saw, the data is mixed, so I'm really using this trust but verify strategy in this recent rally. Just recently we seem to be running into resistance. Market's really struggling to break through this 4,600 level, which is right around the highs from the spring of last year. So that's not a positive. That's a very negative until we see that breakthrough. We talked about excessive sentiment. That's really not constructive for future gains because we are at extreme positive sentiment. But we are seeing breadth improve a little bit, offsetting some of that, and some moving averages going in the right direction. Putting it all together, I think the evidence leans a little bearish, right? The odds of the pullback have definitely increased. Still waiting for those stronger signals to giving the all clear or the batten down the hatches. But I think definitely that until this we see a breakthrough of this rally, trust but verify. Until you see it move higher from here, we may be due for a little bit of a pullback. The other part of your question, oh yeah, where to invest? Yeah, so we don't give specific investment advice on these webinars, right? We're happy to talk to you about specific investments for you to meet your needs, to meet your child's needs, meet your portfolio needs. Give the office a call, go on our website, book an appointment with one of our advisors, Jamie, David, Joe, happy to talk to you. Book an appointment with me, happy to talk to you individually about your investment portfolio. Happy to do that. But I can, without having specific discussions about different asset classes where you should invest in general, you're kind of looking at the market. In general, there are two ways to kind of look at this market, right? In 2023, you get two camps. You have this half full camp, right? And what they're saying is the broader market breadth we saw in June is going to join the party. That's just, and the rally's just starting, and we have a long way to go in the rally. Half empty folks, which is the other side, right? The glass half empty. let's say a few names, that Magnificent Seven really can't hold up this market for long. To me, looking at that, either way, in either scenario, you want to be in stocks that haven't participated in the rally, right? Since if that first half full comes to fruition, right, those stocks have to catch up, right? This is by definition. That's what they're saying. Market the rally needs to broaden out. Those need to rally a little bit higher from here. On the half empty folks, if we really have that sell off in those, it should be concentrated more on those top 7 names, because all those 400 other 93 names really haven't risen as much. So I hope that kind of helps. Things I'm not thinking on where to invest today, but I urge you definitely, if you want more specific advice, please give the office a call. We're happy to discuss your portfolio at any time.
Chris, thank you so much for all this information today, and for all of you who joined us today and on our previous webinars. We do host these quarterly, so you can go right onto our website, www.stonehearthcapital.com. Scroll down on that main page about halfway, and you'll see a link for our webinar calendar. You can go ahead and sign up for our next quarterly webinar, which will happen in November. I just want to thank you all again for joining us, and Chris for joining us, giving us all this awesome information. And I hope you all have a great day.
Thank you, Amanda, and thank you, everyone, and hope you enjoy the summer. Take care. See you in the fall.
Bye. Take care.